Ask your cat.
Right here.
Recording in
Chat.
progress.
All right. Well, yeah, I'll have it recorded so everyone can see it. But again, Dave, thanks for joining again. I think everybody really enjoyed what you did last week, and I'm happy to have you as many times as possible because I think you have a vast wealth of knowledge that we can all really benefit from. So today, I wanted to go over permanent insurance. I know Dave is big on whole life. A lot of us are big on IULs. It doesn't really matter. They're all permanent policies, cash value. It's more about what are the benefits of permanent? Why should we be talking about permanent insurance? How do we propose and present permanent insurance? And how do we compare that to if people want to do term? Like, does term and invested difference make sense? Does permanent insurance make sense? Just have a call and training about why permanent insurance is valuable and beneficial to get you guys to believe in it. And I'm very happy you're here, Dave, because I believed in whole life a great deal when I was starting with Mass Mutual, and then I started and still do a lot of term, which again, nothing wrong with that, but I want to again refresh my mind on why I should be talking to people about permanent insurance and what the benefits are to really get me back to understanding and believing that that's a great product. And I still do believe that. It's just I do a lot of term, but I would like to know myself and get a reminder of where I was at a couple of years ago when I was doing whole life all the time. So Dave,
Right.
you take it away.
All right. Thank you guys for all coming here. I appreciate it. I remember when I got into business many, many years ago, I always used to try, and it still happens today. I always try and I think for my clients that, you know what, maybe this premium is too much for them to afford. And I get scared. Like, wow, I could sell a $400 term case very easily, but what about a $3,000 whole life policy? Man, they can't afford it. And I just try to stay away from it because it's intimidating. I don't want to ask them for $3,000. And that's what I found drove me in the beginning to say, oh my God, why am I setting boundaries for my clients? I know nothing about them. And this is where we really got to get down and sit down with people and ask them important questions because we're all selling to the pain somebody has. And it doesn't matter the product, the person, they have a problem and we have the solution. We just have to convince them of that. And the buy term invest the difference. I wrote something on LinkedIn. I got 3,000 impressions on it. It's a dynamite presentation, and it has to do with sequence of returns. But I'll go over that in a minute with you guys. Um, but the whole life, when we sit down with somebody, I present the piece of paper when I first get there, and I shared this with you guys before who was on here. With a couple questions having nothing to do with life insurance because they have to trust us because they're dealing with a lot of different people out there. Should I trust this person? Because ultimately they are buying us. They're not buying the whole life product. They're not buying the term. They're buying from us because we've established a relationship with these people. And that's what it's about. They have a problem. We have the solution. And that has to be conveyed to them so that they develop trust in you. And I explain, I just have three, and there's only three kinds of insurance. There's term insurance, there's whole life, and there's universal life. Now there's four different variations of universal life. You have the guaranteed universal life, the indexed, the old standard universal life, and the variable universal life, which I don't believe anybody sells it here. I don't know if you're licensed security wise, but I don't have a variable license. I know enough about it. They do have some pretty good products out there, but once again, the client is assuming all risks on these universal life policies, in my opinion, with the exception of a flexible premium regular universal life policy. Um, but the whole life, I call it the foundation of every financial plan. So on top, I have term insurance, the universal life, just briefly explaining each of them, and the whole life. So the first piece of paper, I sit down and ask, do they have a will? Do you have current life insurance in force? What do you have in force? How much do you make per year? And one of the things that I start off, and I always say start off, I bring this into the presentation with people is, the power of life insurance. It is so powerful that the companies only limit you to 30 times your income in the amount of life insurance you could buy. And you let that sit in. Say, if you make $100,000 a year, the most the insurance company is going to let you buy if you're under age 65 is $3 million. Dollars. That's it. It's so good, they will limit you the amount of insurance you could take. Now, that I don't think people know that. And then when they hear that, they're like, wow, that seems pretty good. I can only get 30 times because it's so good. And then there's estate planning if somebody's over 15 million, but that's very, very few, 0.5% of people deal with people like that. So that's unrealistic to talk about that. In that case, yes, they can buy a lot more insurance. Um, but when we establish that, we put a limitation. It's so good, guys. You can only buy 30 times your salary. Okay, if I'm making 100 grand, that's $3 million a year. And just know that number. Just use 100 grand. If somebody's making 80 grand, the most they can buy is 2.4 million. Somebody's making 50 grand, the most they can buy is 1.5 million. So we should know those numbers, just 30 times their income, and bring that to their attention. And by the way, how much are you earning this year? Once again, it's that sell to the need, okay? Um, and with the whole life, we can get into cash values and showing illustrations, but I write this down on a separate piece, on a piece of paper. I write it down what the values are, because when you hold up an illustration, which I'll show you guys in a minute, there are about 200 to 300 numbers on that illustration. That's a tremendous amount of numbers. Their eyes go everywhere on an illustration. That's pretty important to know, because when they look at it, when you look at a piece of paper, I look at a piece of paper, I can only speak for myself. I look and I go, all right, wait, where's I look right to the bottom line. What's the cost involved here? And that we have to get the client to understand, to talk to us on a piece of paper and write down exactly everything they have. So when we find out that there is a need for $100,000 policy, okay? They need it. They have a mortgage for 80,000 or 100,000, and I'll just use 100,000. And my example is for $100,000 term policy, $100,000 whole life policy, $100,000 10 pay, paid up at 65, et cetera. And I used a 45-year-old. While term insurance is great, and I know the adage is, oh, well, they may convert to a whole life policy later. The conversion rate is less than 5%. So when somebody buys term insurance, they very rarely convert to a whole life policy or a universal life policy unless they are in bad health. And they'll usually do it at the end of the 10th year or the 15th year, 20th year, or 30th year, if it's allowable in your state where you sell insurance. Because some of them, they may have a conversion privilege for the first 5 years, the first 3 years. So that's depending on each contract. But when you sit down and talk to them, we find out about their retirement plan. Are you putting away money for retirement? I don't know. That's a question you have to ask. They may say yes. Well, that's great. How much do you put away? I put away $5,000 a year. My company matches 1,000, and that's why I do it. So I'm putting $6,000 into a retirement plan. Now, putting money into a whole life policy, we can ask them, oh, what's your budget? What can you afford? But they may not participate in that, because they may say, I only want to put away $25 a month, and it's not going to work, obviously. But once they understand the power of that whole life, and what I train myself to do is learn those numbers in a whole life policy, to know that if I have a 45-year-old and he's putting away $2,000 a year for a whole life policy, I know the cash value in the 10th year is going to be around $15,000 or $17,000. So we should know our illustrations, is my point. And be direct with them, very direct, and know those numbers and say, okay, well, the dividend's going to be this, the cash value is going to be this amount of paid up insurance. You're going to have an increasing death benefit. We should be very familiar with the illustration itself. And asking people, the 401k plans and things like that, I just simply ask them, how much money have you put away in the last 5 years? And then don't say anything. They may say, yeah, well, I'm saving for this and saving for that. And I use words instead of premium, and this is not deceptive. I say allocating or investing. How much money are you investing in the last 5 years? So this way, there's a company, they're not hearing premium, and that's cost. And it's just more of a psychological sale. But when we can explain the difference between the term premiums, which is like renting a house, and I do put that on the piece of paper. Term insurance is renting a house. It's going to give you protection, going to have a roof over your head, going to have heating, cooling, and it's going to be nice. You have a bed in it, but you're not getting anything at the end of that term frame. You're renting the house. Whole life is buying the house. You're going to have equity, but usually equity comes when it's further down the road when we own houses. Because, when we first buy a house, there's a tremendous cost up front. You're not building any equity. Kind of stinks. You're like, wow, 5 years, 10 years, I don't have any equity in my house. It's the same thing with a whole life policy. We are buying the house with a whole life policy. And then it comes down to actually looking at the numbers, and I'll share with you on my screen. I got to send a request to Nick to share my screen with you. And if I can get it up here. All right. Is this sharing now or no? I don't know.
Not yet, no.
What do I got to hit? Share. Okay. Is that sharing now? Right?
Yeah.
Okay. And we should know that, this up here, you can see it's for a 45-year-old preferred non-smoker, $100,000 death benefit. 10-year, 15-year, 20-year, and we just gave him a preferred non-smoker. Now your rates may be better, it may be less, I don't know. But what I go over, and I put this on a piece of paper, you could show this, but on the bottom of the paper, I didn't write it on this one. But after 10 years, he puts in $200 a year for 10 years. What's his cost at the end of the 10 years? How much did he shell out? $2,060, right?
Mm-hmm.
Okay. Now you go out 15 years and he puts in around $3,500. In 20 years, 20 times 320 is about $6,200. So at the end of 20 years, he's had protection of $100,000. He's put out over $6,000 and has nothing to show for it in the 20th year. Okay. Now, what I did, this is a 10 pay, but this 10 pay, and then I did a paid up at 65. Okay. Well, yes, the premium is $3,000. And once again, showing this to the insured, I just put it on a piece of paper, just these numbers, $3,000 a year, or break it down monthly to what it would be on a monthly basis, which is $250 a month, I believe. Um, After 20 years, you've put in how much money in 20 years? $60,000. What's his cash value in the 20th year?
68.
$68,000. Mr. Client, how much did this policy cost you?
Zero.
And then don't say anything. The other advantage here is what we put on here, and I put it on every whole life policy. It is a rider that I would not sell a policy without, and that's the waiver of premium. They may have a 401k making contributions to a 401k. If they get hurt, are they still going to make the contribution to the 401k plan? And you have to ask them this. Mr. Client, if you get disabled, who's going to make your contribution for you? What are they going to say? You let them talk. So remaining silent after we talk, after we ask a question, is probably the most powerful thing we could do in sales, and let them talk about it. Here, Mr. Client, if you become disabled, we pay this $3,000 every single year for you. And I lost everybody.
What?
Did I lose everybody or no?
No, we're here.
Oh, no.
Okay, all
Nope.
right. Sorry about that. My screen just went blank and I'm having problems.
No, you're
So,
good.
I just went blank again. It came back again. Okay, no problem.
No, I lost your screen. Up there it
What's
is.
that?
It's showing.
Okay. So, Mr. Client, if you become disabled, we make these contributions on your behalf. So at the end of 20 years, you will have that $68,000 and you will maintain that death benefit in the unlikely event you become disabled.
Can you
That's
just
waiver
briefly go
premium.
over the waiver premium, Dave, how it works
The
so everyone
waiver
understands
premium
that?
on a whole life policy will waive that premium. The insurance company will make your premium payment on your behalf. All of that cash value still belongs to you as if you were making the premium payment.
And what qualifies as that disability?
The unable to perform material substantial duties of your own occupation.
I believe it's 6 months.
6 months. After 6 months, they'll begin waiving. And I've had clients that have been out on waiver of premium, and it's been a big, big, big benefit to them. And some of them have been some pretty large premiums. So the difference between the universal life waiver and the whole life waiver, the universal life will only waive the cost of insurance. Now, there is a rider you can pay for, very similar to this with disability rider, that will waive the scheduled premium, but I don't know if it's approved in your state, and each carrier is different for that. But this is a very powerful rider, guys. This also has the chronic illness rider, which allows you to access, at least with this particular company, each company is different. They will allow you to access 25% of that death benefit in one lump sum. This is security mutual, but it doesn't really matter. Some companies do it on a monthly basis. And that's if you lose 2 out of 6 activities of daily living, which are eating, bathing, drinking, eating, bathing, driving, getting dressed, cognitive impairment, and feeding yourself. So if you cannot do 2 out of 6, you have access to 25% of that death benefit. That's $25,000 they can access. Obviously, larger death benefit, you have larger access to the policy. $500,000 policy, they can take out $100,000 a year. They only have to leave $50,000 death benefit. So that's a big benefit on a whole life policy. Not sure too many term policies have that. There are a few companies that do have it. But once again, this is the power of a whole life policy. So you have tax deferred cash value growth. You have a death benefit. You have waiver of premium in case you become disabled, and you have a chronic illness rider or long-term care rider. So you have 3 riders which are absolutely, you have 3 policies in one: disability policy, retirement income savings policy, death benefit, and a long-term care. So 4 things if you want to technically say 4. But this is for a 20 pay. So you can't pay more than 20 years on this policy. It is truly paid up at that time for $135,000. The death benefit is $135,000 and will continue to grow. You also have access to, excuse me, to the dividend to the left there. You can see 1701. They could take that dividend out every single year in cash if they wanted to and still maintain that $68,000 and 135 death benefit. So that's pretty powerful, folks. When they understand that, they may change their tune a little bit. But this is a 20 pay. So on the 20 pay term policy and the 21st year, you lose everything. You don't have any more. It's gone. Here, this death benefit continues and it goes out to age 121. But then I ran also just the standard whole life policy where the premium is $2,200 a year. The investment is $2,200 a year. That's what we like to say. And even after 20 years, at 20, it's call it $2,000 a year times 20 years is $40,000 plus another 200. So it's $44,000. They have in cash value of $48,000. What did it cost them? If they surrendered this policy at that time, we'd write a check for $48,000 to them. What was the cost to them? 0. They actually made a few bucks. What's the cost of the term policy? $6,000 has left your pocket. So whether you use a whole life policy or a cash value policy, you're still going to have values. Now, the universal life policy may have a tremendous amount more of non-guaranteed values, and we don't really need to get into that now, but it's the idea of asking people, how much do you save? How much have you saved in the last 5 years? Would you have any objection to having something like this? So it's pretty powerful once they see it. And like I said, it's hard. Look at all the numbers that are on this page. There's 5 in the first class, 5, 10, 15, 20, 25, 30, 35 per line. In 20 lines, that's a lot of numbers, But I put this on a separate sheet of paper. And then, of course, when you have to get into this, if they really want to get detailed, of course, you print the illustration. It's 27, 28 pages, and you can go through it with them at that time because it's going to have to be signed. but and it's not skirting the it's not skirting the liability. You have to disclose everything to them. But if they're on a separate sheet of paper and you show it side by side, it's a lot cleaner. So if you put in, if you just divide 2,200 by 12, you come up with $210 premium, $220 premium per month. And at the end of, at age 65, you're going to have a nice nest egg of $48,000. So, if we ask them, how would you feel about that? It's a big difference. We can have this money saved, policies paid up, walk away from it, take the cash value. And when you get into bigger cases, say you work with doctors or lawyers, where they're putting in $21,000 a year as opposed to $2,100 a year, just put a zero at the end of that 480. So you're going to have almost $500,000 in cash in 20 years. Big difference. Now you're talking about a nice retirement plan for somebody. They can borrow against the cash value. They can take the dividends out if they want, take a loan on it, take a withdrawal on it. But you have the waiver premium, the chronic illness rider, the tax deferred growth, the cash value of the policy, and the death benefit, which are a huge benefit. The term policy doesn't have it. But I know this $2,200 premium would scare some people right out the door and say, oh my God, they'll never buy that policy. And if you want to compare it to something, you can simply ask them, how much do you pay for your cell phone bill? What does that bring you at the end of the year? You shelled out $100 a month for 10 years, 15 years, you have a cell phone. Great. $200 a month for your Netflix cable bill. So we have to find a way to allocate that money in a different manner because they may have it, they may not have it, but we can't think for them. We have to ask them. And sometimes it gets a little difficult to say that. Hey, how much money are you earning this year? How much money are you saving? Have you saved money in the last 5 years? So it's key. We can't talk ourselves out of these policies, which I used to do 35 years ago. They're never going to be able to afford that. And then once they see it and they understand it, the power of that growth of the cash value and the death benefit and knowing that they're going to have something in 20 years, it's pretty big, you know? And we can't talk ourselves out of it. We have to be confident. And in doing so, I was told when I was younger to buy one of these policies. And I actually did buy one a very long time ago. And I used to carry it around with me and carry the annual report going, here, look, this is what I have. This is what I'm paying. I believe in it. So, they see it and it's pretty powerful. It really is when they understand that tax deferred growth and the way we present it to them. And then there's other benefits. The 401k is going to be taxable. This nest egg that we have here is not going to be taxable if withdrawals are done properly. There's certain tax consequences if you surrender the policy in its entirety. But we have to get, before I would go out and present this, I would recommend that you each sit down and we can go over in detail how these actually work and design it for somebody and say, hey, this is a case design, Dave, here. I got this guy who can allocate $300 a month. What could we do for him? We could put in $300 a month. You can get a $500,000 policy. We could put in $300 a month and we can get a $100,000 policy. We could force more money into these contracts to build the cash value. Do they want cash accumulation or do they want a death benefit? We could put a term rider on these policies and bump this death benefit up to say 250,000. So there's so many variations what we could do, but we have to talk to them about how much they can allocate or invest towards something like this. And that's the power of it. Because then we design it. We could design it for them like when you buy a suit or a dress and you go bring it to the tailor. Okay, I got the suit and dress. That's great. Now I got to tailor it to fit me. What can I afford? What can I put in here every month? What can I stick with? And I know I'm going to do this. It's not going to be uncomfortable for somebody to have this. And there's flexibility in these contracts. A lot of people don't realize that. You're not bound by the $2,200. After a couple of years, you have some dividends in there. You have some cash value. You may be able to miss a premium payment, but I don't want to get too involved with that right now. It's just a matter of don't be scared of these contracts because they are pretty powerful contracts. And the same thing with if you look at a 10 pay, here you put in $40,000 You have 39,000, you have all your money back in 10 years. What's the downside to that? Mr. Client, if you don't like this, in 10 years, you can walk away with all your money. After 20 years, you got 61,000, you put in 40, you made $21,000 and you have a $122,000 death benefit. Is that a downside? Is there a downside to that? So asking questions is paramount in these approach to these kinds of contracts because we could talk ourselves right out of one of these. And sometimes we talk too much. I talk too much and talk myself right out of it. And the client doesn't want to hear it anymore. So we proceed very slowly. We ask questions, find out what their pain points are, and see, get their opinion on this. Hey, what do you think about having something like this? So they're very important contracts because I call them the foundation of every financial plan. Because the stock market goes up and down, these are pretty much stable. There's guarantees in the whole life that you don't have anywhere else. You're guaranteed to get all your cash back in this policy in 13 years. Guaranteed. Doesn't matter what happens to interest, dividends, nothing. So, there's some very powerful phrases that we can put into play. Each case is going to be different for each person. Now, you could do a $4,000 premium for 100, you could do $50,000 death benefit. You could do a $250,000 death benefit. Just don't be scared of these. Just run them out, see what the term costs are, and then compare it to the whole life policy. And always bring it with you when you have a term compare. When somebody wants to buy terms, hey, let me get your opinion on this whole life policy. If you allocated this amount of money and you had this cash value at the end of 20 years, what do you think about that? And let them tell you. They're going to like it, not like it. Well, what do you find? What don't you like about this policy? Well, I could do better elsewhere. You probably can. You're right. Buy term, invest the difference. I don't know if you guys have ever run into that, but that's what I was talking about with sequence of returns. If we buy term, invest the difference. Have you guys any of you guys heard of that yet? Or no? Have you heard the buy term, invest the difference stuff?
Yes.
Yeah, because I used to work for Primerica. That's where I started. So yeah, that's their main slogan right there.
I know, right? Exactly. And I'm just I'm pulling something up. I wrote it, and these numbers are 100% true, and anybody can do this. The buy term invested difference is great, but there's a major factor that they tend to leave off, and I don't know if you guys have ever heard of it. It's sequence of returns. While they always say the stock market has averaged, 8% a year,
Hmm.
um, I did a little comparison and I used a 45-year-old, and I could send this to you guys after it's saved somewhere on my desktop. I don't know, but a 45-year-old, if he wants to buy, and Nick, I will give this to you, a $250,000 20-year term, okay, the premium's $700 a year. Just a ball. That's just a ballpark. I'm sure you could probably get it for 550 or you can get it for 800, but just for, illustrative purposes, it's $700 a year right now, and that's about average of what it would be for most term companies. A whole life policy with waiver premium and a chronic illness rider and a living benefits rider would be $7,280 a year. Okay, so guy looks at that, wow, $7,000. Your Prime America guy will say, okay, you know what? That's $6,600 to invest. Okay. And we can get an 8% return on that money, and you're going to have a whole heck of a lot more money in that policy. And when you illustrate 8% consistently over 20 years, yes, you're going to have a tremendous amount more money. Okay. But what they fail to tell you is let's assume, and this is a guy in a 25% tax bracket, assuming 3% inflation on an 8% return. If he has one market decline in the 10th year, one market decline where the stock market doesn't perform, it is down 15%. Okay. The market is down in the 10th year by 15%. At the end of the 20th year, the cash value in the whole life policy would be $182,000 with a $435,000 paid up policy. The investment portfolio at that time frame would have $194,000 in it. Even though it earned 8% a year, if you have that one sequence of returns that is bad, 15% down, you will have, and I know this number, it is factual, you will have $194,000. So is it really worth the $14,000 difference to buy term and invest the difference?
Plus taxes in the future, right?
Well,
No.
I did take out
No
the
way.
I did take
Oh,
out
you
the
did that
taxes.
accounting for
I
taxes?
did take out the taxes. So 182,000 in your whole life policy, cash value in the 20th year compared to 194,000 in your investment. Mr.
I
Client,
love the way you put that.
is that worth the risk?
Wow.
And that's a number you could run them. You could I use Dinky Town returns. You could anybody could do it. And what they don't if you have $100,000 in the stock market and you sustain a 50% hit, you are down to $50,000. If the stock market does 50% the next year, you're still in the whole $25,000 because now that 50,000 just went to 75,000. You're
Wow.
still 25,000 short of 100,000. Now, what is it going to take to come back? So, the buy term invest the difference, if that happened, say in 2007, 2008, when the stock market took a 53% hit and you were retiring then, that's a big hit. So we got to be careful. That sequence of returns, if it doesn't, and they say timing is not everything. Well, timing is everything, yes. Because when you take a time period and say, okay, since the inception of the stock market, it has performed 8% a year. What about those bad years? What does it take to get back? And that's what they're cutting out. They're not showing us that. So if that sequence of returns happens in the fifth year, sixth year, seventh year, eighth year, 10th, it doesn't matter when that happens. It's just the fact that it does happen. The later it happens, the worse off it
You
is.
may not have a chance to make a comeback from that,
Absolutely
which is
correct. So
horrible.
the
Yeah.
buy term invest the difference, when we run into competition with that, I really don't have too much competition today, but because I've known my clients so well now, they listen to pretty much everything I tell them. But you do run into them once in a while, and when that's presented that way, that's a tough thing to fight against. If you're the buy term invest the difference guy, well, what is it going to say? Show me your numbers that are different. It can't be different because you have to have a bad return in 20 years. It just doesn't go up 8% a year, even though statistically that's what they tell us. Maybe 10% today. I don't know. Well, if it goes up 10%, let's take a bigger hit then. Maybe you take a 25% hit in the 10th year. But if I did a 53% hit, like it happened in 2007, 8 in that time frame, forget the cash value in the whole life policy would beat it every time. You'd never make a comeback to the cash value of the policy. So yes, it is a tremendous a lot more money, but if you're going to invest it, that's $6,600. Okay, invest it. It's not going to come out to be the same. Plus you have waiver premium on the whole life. So if you become disabled, who's going to put your $6,600 away? A whole life policy, you're going to have the premiums paid on your behalf. So it's a very powerful contract when we understand it. And like I said, it's the foundation of every financial plan. It's just like the Queen Mary leaving from New York, going to Britain. You have a 99.9% chance it's going to make it. It's going to be slow. It's going to be kind of boring and, not too much, but you're going to make it. Or you can take a speedboat. You may get there a lot faster. Speedboat may break down. You may sink. A lot of bad things can happen when we want to speed through it. So whole life is, I tell clients, is boring, guaranteed. That's what I like. I like sleeping at night. I want you to sleep at night, Mr. Client. I don't want you to worry about the stock market. I don't want you to worry about interest rates because right now interest rates are probably at an all-time low when it comes to whole life projections. And, they probably have never been this low in the history in the last 40 years that I've been in business. They have never been this low. They're slowly making a comeback. They don't come back as fast as bank returns or mortgage rates or something like that because they're such a insurance companies are a behemoth and they move very slowly. So you won't see an uptick in interest rates unless it sticks for the next probably 5 or 7 years. Maybe you'll see a couple points up but they're pretty boring right now. But what we sell, I tell clients this, I sell guarantees and I like to sleep at night and I want you to sleep at night, Mr. Client. And a very powerful product, and there's really no downside to it. And I just simply ask them, what do you think the downside to this product is? And I've learned it's very hard, but we have to ask questions. We can't just talk our way through this illustration. Asking questions and finding their pain point. Maybe they can't afford it. Okay, well let's invest only a little bit less. Let's invest a little bit less. Let's allocate a few less dollars in that. Maybe get a whole life policy and blend it and get a term ride or two on top of it. So, once we understand this and the more you work with them, the more you run illustrations, and it's a very powerful product, especially when you compare it, you write it down. These numbers don't lie. That's the thing. But we have to convince them that they can afford this in the first place. And just simply ask them, how much have you saved in the last 5 years? How much do you put away every month? Where are you allocating those funds to? Well, I have an emergency fund. Okay, well, how much do you have in your emergency fund? So we have to ask questions to find out to get them. You could direct them right into this type of contract immediately. It's just a matter of not being scared of it. Like I was. I was intimidated of these products when I first started because I thought there's no way they're going to be able to afford that. Then they come back and say, hey, you know what? This makes sense. Can I do more? Sure, we could do more, but we have to have a positive attitude when we're explaining this and write it out, know the illustrations, know the values, and be confident in it. And like I tell everybody that I work with, we have to get red hot for our client to get lukewarm. So we have to be excited about it. We have to really push this and say, hey, wow, what do you think of this cash? How do they do that? You get $61,000 in 20 years. You only put in 40 and you have the protection of a $100,000 policy that's tax free to your kids. Holy cow. That's amazing, isn't it? So we can't be bored about this. I'm talking slow so you guys understand it, but when we get in with the clients, we have to be upbeat about these things.
Hmm.
It's a waiver of premium. You become disabled, who's going to fund your 401k? Don't say anything. If you become disabled, Mr. Client, who's going to put your money away for you each year? Well, I don't know. How do you feel about the insurance company making these contributions on your behalf and all this cash value belongs to you? Oh, wow, that's pretty good. Okay. So, you know, and I know I'm talking very slow, but I get pretty excited when I talk to clients about this. And, there's been some very large premiums in this field, let me tell you, because once they understand this product, a lot of people, they have some money. You may not know about it. They, have a rich uncle, a rich dad, rich mom, brother, sister, they can afford it. Once they see the power of this, they will start putting the money away, and it's a very powerful product, and we have to convince them of that. And they will realize it once they understand the power of this product. Now, the universal lives are a total different horse. It's a you have investments and ups and downs and things like that, and zero, you can't lose money and all these things. That's a whole. I'm talking about just guarantees for the whole life policy, and then from this stems the universal life, a little bit more flexibility. You don't have the waiver premium. Some contracts don't have that waiver premium. The access to the death benefit in case the chronic illness rider kicks in is only 2% of the face amount of the policy. So there's a little bit of differences in every single contract. But
Dave, let me ask you something if you're done there.
go ahead.
So as a professional, I'm not like it's either IUL or term or whole life or term. I like to see what the client's needs are. So the way I position and bring up whole life is usually when they're looking for guarantees, right? They're not looking to maximize and take risk, right? A whole life, I think, is very suitable for people that want to know at the end of the day what they're getting, right? Like you said, a cruise ship going from here to England, slow and boring, but you know what you're going to get. And that's what a whole life is. It's a lot of guarantees, it's a lot of security, it's a lot of safety. So I think if your clients are looking for that, they're not really much on taking risk and they don't really care about gaining as much value inside the policy. This is great. And then there's IULs, which I think are great products too, but those are for certain individuals that maybe want to take a little bit more risk, right? With the investment portion, the cash value part, but it doesn't have as many guarantees, right? Is that how you would describe the difference between IUL, like when to position, say, an IUL versus positioning a whole life, right?
Yes.
Because if you look at the illustration of an IUL, it's going to look way better than whole lives, but that's illustrating a certain percentage in returns. And like you said, the sequence of returns, the cost of insurance, and the fees involved. What would you say is good for saying like an IUL, and when maybe we should switch to a whole life instead of an IUL?
Yeah, well,
Because we do a lot of IULs, Dave, just so you know.
oh
That's what
yeah, I
most
know. And
people are doing nowadays.
there's nothing wrong with IULs. I have taken old whole life policies that people just say, Dave, they haven't made the premium payment in a couple of years because it's too burdensome. And they've had a big loan on their policy. We have changed them into an index universal life policy. So there are places for that contract. And I'm not saying it's a bad contract. I'm not saying it's better. It does serve its purpose when it's used properly. And I find that on a whole life policy that has a massive loan on it. I just did one last year. The girl, it was a doctor. She had $426,000 of cash value. She had $100,000 loan because she hasn't paid her premium in 5 years. Her premium was 24,000 a year. So she didn't pay her premium in 4 years, 5 years. So she had $100,000 loan on the contract. That interest is 5%. That's a big, big carry right there, $5,000 a year, and it was coming out of the dividends and cash value of the policy. So we used that $300,000, made one contribution in the first year via 1035 exchange, bought an IUL contract, lowered her premium to $16,000 a year, and she couldn't be happier. Because when you don't pay the premium, the biggest difference between whole life and an IUL contract or a universal life contract is this. If you do not make a premium payment on a universal life policy, you do not create a massive loan against that contract. You're only taking out the cost of insurance. That is a huge feature that and a benefit I consider that the whole life doesn't have. Because on some whole life contracts, if they cease those premium payments and have not put enough cash value into that policy, those loans can become daunting to the contract to the tune of $100,000 a year and then 5,000 of interest plus the $24,000 premium they're not paying. Now you're talking about $30,000 a year coming out of that contract. That could be a big problem. So, when these are funded, I try and stay away from, you don't have to pay all the premium, just keep doing it, keep paying the premiums. That could be painful to some people in later years. Now, do I explain that to them in the beginning? No, I would never explain that as a pain point. Hey, 20 years from now, if you want to stop paying, you're gonna have a big problem. It's not being deceitful, but I just don't go down that road. If they want to continue to make these contributions, keep making the contributions until you're 100 years old. The IUL or the universal life, while you don't have to make those contributions, you're not going to create a massive loan against that contract. So that's so if I'm on the IUL side or universal life side, which I have placed a lot of universal life policies, when I first started in business, take a wild guess what the interest rate was when the universal lives were crediting on their UL policies. Anybody take a guess? This is in the
13,
late 80s, early 90s.
12.
14%. 14% rate of return. They were saying that was going to go out until 2025. 14%. You know what that cash value was supposed to look like? A tremendous amount. They were supposed to have $300,000. Meanwhile, the inverse happened. Interest rates started falling. Those cash values shrunk up. Instead of having 200,000 in cash, they only had 87,000. It was a huge hammer to the market. And a lot of IUL, a lot of universal life policies couldn't hold up because the cash value wasn't there. Now, then they look back and I should have bought a whole life policy. Well, yeah, you're probably right, but it happens. I don't know what's going to happen 20 years from now. Are rates going to be higher? Are rates going to be lower? I can tell you right now, rates are very low. So that projection going out forward is not 14%, which is almost, it was unrealistic. And it's almost that same way today with some IULs, assuming that they're going to pay you 8% or 7%. That could fall apart pretty quickly if they don't pay 7 or 8%. We got to be mindful of that, and that's why it's always important to review with your clients every couple years. Keep that illustration that they bought, and then when they get their annual statement, say, look, well, we said you'd have 23,000 over here. You only have 18,000. Ooh, boy, we better start funding this properly. So we got to do that in our business. That's our due diligence, to make sure we take care of the client. One, first and foremost, is make sure they understand what they buy. You review with them, and you got to make that very clear to them. The whole life, it's more like it's like it's like a roller coaster ride. It'll just keep going and going and going and going. You don't have to really necessarily worry about it. Yeah, you should do reviews, but you're not going to have huge spikes. So we have to watch these products that we're giving to the clients that they're buying from us, that we go back and review with them. Any changes, maybe we should put in. I've had a couple people that, you know, are a little bit older right now. I have an 85-year-old client. She's got a $5 million death benefit. She didn't pay her universal life premium for probably 2 or 3 years. Her premium $78,000 a year. We exhausted all the cash value. Now she's got to make that premium payment. And now it's $19,500 per quarter. She's not healthy, but I've told the trustees, because it's owned by a trust, we got to make sure this premium payment is paid and paid on time and get into the company, because that could be a pretty dangerous situation. She took the policy out a number of years ago. Interest rates were a little bit higher, but she didn't pay those premiums. So, you know, not that it created a loan, it's just the cash value is not there to generate the interest that should be earning. Instead of getting $28,000 a year, now she's getting $2,000 a year. So it's a big difference. But we have to keep in touch with our clients, and the whole life is just it's another investment vehicle that we use for funding to provide protection to the families, because that's ultimately what they want, is the death benefit. And I've been asked many times, what's the best policy to have? And my reply, I'm sure you guys have heard it before, is the best policy to have is the one that is in force when you die. There's nothing else but that, because that's what they want. And I've paid 55 claims in my short 39-year career, 55 claims. And not one spouse has ever said, take some money back, David. This is too much. They've all been very grateful. We're usually the second or third person they call. It's a pretty powerful contract, but we have to convey this to the clients. And how you do it, I can't tell you how to do it, because I don't know. Everybody's personality is different. Some people have a slower approach to it. You listen to different people. Oh, you should say this. You should definitely say this. I can tell you what, it is a psychology game. And when we learn to use certain little phrases, and once again, I can't tell you what those are. We develop them after you listen to a number of people to match your personality. Because if you're saying something that sounds like you memorized it from somewhere else, it's not going to go over too well. So we're each in our own. We talk to the people we know. We talk to friends of ours. We talk to family members, and they know the way we speak. So when we convey a message, we have to be heartfelt, and you really have to hit that pain. Like, okay, I have a problem. Dave is the solution. Or I have a problem. Nikki's the solution. Christina's the solution. Eddie's the problem. Wes is the solution. You know what I mean? So it's hard for me to convey that to you. I give you suggestions, but we have to be confident to our clients. We have to know what we're talking about, and we have to get rid of the ums and likes and things like that. I've said it the last thing too. We have to be direct on what we say and practice it over and over and over and over again, so that we don't screw up. We know the whole life contract. We know the differences between all the contracts, and you're bringing knowledge and wisdom to the table, and that's what they're going to like from you. And then the last scenario is, okay, I showed you term, I showed you whole life, I showed you universal life. Which one you want to go with? Okay. We did our due diligence. If they say term insurance makes sense, don't try and talk them out of it. Sell them the term policy. Never talk yourself out of that. We want to make sure they have something from us, make them a client, I've heard in seminars they've always said, "Oh, who do you market to?" And my reply is anybody who's got a checkbook. If you want to write a check, I'm willing to talk to you. Because you'll hear guys, well, I only deal with high net worth individuals. Oh, what's high net worth? To somebody who has $400 in a bank account, a guy that has 25,000 is a high net worth individual. So what's your definition of high net worth? What is that? What does that make you sound like? 100,000 is high net worth, 200,000, a half a million, 5 million, and I've dealt with people that say my clientele, they only make minimum of $250,000 a year. You know how many clients I have make $250,000 a year and can't even pay their phone bill, their cell phone bill? They're living paycheck to paycheck. So it's irrelevant what people earn, in my opinion. It's what they save. How much are you saving each year? That's where we come in as a savior. Hey, let's put some money towards a whole life policy. Let's put some money towards a tax, and you could say whole life. I mean, I handle things differently now with my clients because they know where I'm coming from. When you're talking to somebody new off the street, let's allocate some funds in a tax deferred plan and you have a tax-free death benefit. Would you have an objection to that? That sounds really good. So it's how we say those things as we develop in our history, in our employment through this business. And
Can you repeat how you said that? I'm sorry.
I'm sorry, say that again.
Can you repeat how you said that exactly?
Oh, what, the
Tax
allocation?
deferred
Yeah,
plan. Yeah.
how would you like to allocate money into a fund that grows tax deferred, can be taken out tax free, and provides a tax-free death benefit to your family?
Thank you. Allocate money. So how would you like to allocate money?
Funds, money, yeah. Would you have an objection to allocating funds into a plan that grows tax deferred? You could take it out tax free and provides a tax-free death benefit to your family.
Thank you. I love that.
Yeah. And then you just, you phrase it to the way you like it. And then the psychology of sales, that's a 4-year course.
Thank
You,
you.
you
Thank
you
you,
know,
David.
you're not, you can watch things online and this is the way you should say this, and this is the way yeah, there are certain things to say. I can't tell you all of them. It's just when you sit down with a client, you get that feel. And that's what I thoroughly enjoy with being in person. I'm not taking anything away from Zoom. That's great. You could accomplish the same exact thing. I just not, it doesn't, I don't like it. I mean, I shouldn't say I do like it, but I just feel better meeting with somebody in person. That's all. I get to sit in their office, their place of work, either at their house. I did so many kitchen table sales that it's absolutely, and I used it only because I learned it in the beginning. Because when I first used to go out and sell insurance, we had a rate card. We didn't have illustrations. So we had to calculate by hand on a piece of paper. You put $30 a month away, $33.50 a month away for a $25,000 death benefit. At the end of the 10 years, you're going to have $17,000 of cash value. Holy cow. Okay. And that's all, that's basically where we stopped. We had a piece of paper and wrote it out on a piece of paper. Today we have spreadsheets, illustrations, 46 pages, this growth, look at this, look at that. Put it on a piece of paper, make it simple. Hey, we allocate $200 a month. In 15 years, you're going to have $42,000 in cash and a $200,000 death benefit. Okay. What's your name, address, social security number? Who do you want the beneficiary to be? Because we could talk ourselves, I could talk myself right out of a sale by explaining too much. And I'm explaining it to you guys, not to sell you. And I just want you to cover everything. And we got to learn when to stop. We got to learn when to say, don't say a word. Let the illustrate, let the numbers speak for themselves and ask them. So those are paramount things that we have to do, guys. And don't be scared. Like I said, I was scared to death to sell. There's no way he's going to afford $200 a month. No way. And all of a sudden, Yeah, Dave, now that you put it that way, I'm gonna have cash value. All right, I'm gonna do this. What? Holy cow. But it's up here. I talked myself out of hundreds of sales when I was first in the business. And we have to be confident. We have to know the product. And when we know the numbers, it works out very well.
It's the saying, cost is only an issue in the absence of value.
That is true. Well, there's a cost to everything. Usually there's a cost for everything, whether you buy it or don't buy it. And usually if you don't buy it, it costs a lot more. And I've had phrases, I mean, I get this a lot, and my reply is well, how much is a whole life policy going to cost? My reply is if you buy it or you don't buy it. Don't say anything. So I have certain things that I say, and they just come up in a conversation and they hit me. Okay, well, this is what I use. And I use it all the time. Well, Dave, how much is that policy going to cost? If you buy it or don't buy it? Oh, okay. Now they understand, you know. So it's very psychology. The psychology is tremendous in this business or in any sales business. Using words like invest, allocate. We're gonna transfer the funds from your checking account.
Like
Nothing worse than
contribution.
saying we're gonna take money from your checking account. Take it? What are you talking about? No, we're gonna transfer funds from one account into another account. And those are just things that come along. And like I said, it'd be 4 years of taking a class to learn everything about there is to know about selling. But once we develop a niche and practice it and talk to others about it, that's when we get good at it. But guess what, folks? We have to practice it. We have to say these things out loud. You could look at an illustration and, boy, this is great and understand it. But if you don't share it with somebody or talk to somebody, practice selling it to somebody, your friends at home, your other guys in meetings like this, like, how do you sell this product? Okay, this is how we do it. It could be a good way to have, and it's hard because we do it and we don't want to be analyzed. And I think I had said the first time, record when you're talking to somebody on the phone and then listen to yourself afterwards. Same thing here. You record this, just like athletes, pro athletes get coached all the time. They look at the films. So if we go back and look at a film and say, Christina, you know what? This week you're going to have to sell to Eddie. I want you to sell him $1 million term policy. All right, Christina, go. You just walked in his house. Go ahead. You know what I mean? So when we do that, I'm scared. What? Are you kidding me? Eddie's not going to buy from me. But that's my point. It's when we practice these and then I critique. Wes comes in and critiques. Nick will say, hey, maybe you could say this differently, Christina. And then we build it off of each other so that that's the only way we're going to get better is if somebody critiques you or looks at you and says, you know what, I wouldn't say it that way. Maybe we could say it this way. Then the whole room, the Zoom meeting says, hey, you know what? That's a really good idea. You write it down. Guess what? You'll use it for the rest of your life. But you have to find out what works for you. It's just not like reading a board going, I like that sales approach right there. I guess maybe some people can do that, but if we practice it amongst one another, I still need practice. That could be a very, very helpful tool in that everybody sees someone else the way they sell, you know? So it's pretty good.
Yeah, I
There you
think
go.
it has to be something that definitely needs practice and has to come more naturally, for
Exactly.
sure.
Yeah.
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 So you guys gotta let us know when you have appointments so we can listen. It's so we can help each other. I know you guys
Exactly.
hear me all the time. You hear how I do it, but I don't hear how you guys are doing it. I appreciate
Right.
feedback. There's a lot I can improve on, I know. So that's the point of having those appointments that we all listen to together is so we can help each other
That's a great point. That's a good
and
point.
learn from each other.
Yeah. I mean,
Right?
you're never too old to learn. The man who fails to learn is going to fail. Always have to get better. And I could learn something from Eddie. I could learn something from Wes. Christina, I can learn something from you too. Nick, not so much, but
You can learn something from Nikki tomorrow, Dave. Join her call. She's gonna go over IULs, your favorite.
I would love that. Yeah, no, I,
She's
I have
going
no
to.
objection to IUL. Don't get me wrong. There's nothing wrong with them. I mean,
Yeah,
yeah,
maybe you'll learn something. You're like, hey, you know what?
they
Maybe I'll
serve a
try
purpose.
these out. Yeah, hers is what time tomorrow is that? 4 Eastern time.
Okay.
Uh,
Um, I can tell you one thing. I'll just share one whole life, and I use this because I used it at my doctor's office the other day. Whether or not he does it, I don't know. But he just had a granddaughter. And I just did this for my granddaughter, and I've done it a number of times for other grandparents because I'm at that age now. I'm 62. I have clients that have babies, et cetera, et cetera. Their kids have had kids, et cetera. But I just remember this, and I shared it with Nick, and I'll explain it, and then we can go through. I'll just explain it, and then you let it be at that, however you want to describe it to the client. But what we did is a 10-pay contract, a 10-pay whole life policy. In other words, they can't pay more than 10 years. That's it. The premium for a 1-year-old or 0-year-old juvenile policy is, and we just picked this number because it's $300 a month. It makes it easy. It's $3,600 a year. Okay. You're only paying for 10 years. That's it. You can't pay anymore. Baby is zero. $3,600 a year. Most whole life companies have this. I say most because the companies I deal with have it. We have what they call a premiums paid in advance account. They write one check for $29,000. Now, don't let that scare you that I don't know anybody that could write a check for $29,000, but you may deal with a client that has a grandfather, whatever. I'm just giving you an example. And I've done a couple of these, and it's just it's very good. They write one check for $29,000. They prepay 10 years of premium payments. So they get a discount of $7,000 by paying that up front. Now, between you and we do cover this, but not right in the beginning, that $7,000 is a taxable transaction. They will get a 1099 for that each and every year for the next 10 years. But leaving that beside. Now they put in 29,000. At the end of the 10th year, they have well over $29,000 of cash value in that policy. When the baby turns 18 years old, on either grandpa's birthday or that baby's birthday, they could take out $2,000 a year every single year for the rest of their life, tax-free. Just think if your grandparents did that for you. And you're 35, 40, 50, I don't know how old any of you guys are, but just think of that. $2,000 a year. And then somebody smart aleck will say, well, that's not that much. All right, well, then put in $60,000 and take out $4,000. But the point is, it's called legacy planning. And that's the way I phrase it to my doctor. Hey, did you ever create a legacy? Would you think of creating a legacy plan for your granddaughter? What do you mean legacy plan? I could be here next Tuesday or Wednesday at 3 o'clock or 4 o'clock. What's good for you, doctor? Oh, I'll come by at 4 o'clock. There's my appointment. So we call it legacy planning for a grandchild. Said nothing about life insurance. But that's the way I explain it. We have a fund. We're going to allocate $29,000 into this fund. When the child's 18 years old, they could take out $2,000 a year, tax-free the rest of their life. How do you feel about that? Holy cow, where's the paperwork? What do we got to do? Did I mention anything about whole life insurance? So that's my point is when we get comfortable doing things and we present it that way, and you can cut it in half then. Say do it instead of 29,000, do 15,000, do a $1,500 a year 10 pay. Now it does generate a substantial death benefit, and we're not here for the death benefit for a zero person age or a child, I should say. It's a $400,000 death benefit. So the parent has to have, at least in the state of New Jersey, at least 5 times that amount of life insurance. So, that's the kind of client we have. It could be a $2 million term policy, million, it doesn't matter, but they're going to need to have at least 5 times that amount. But it's just something that, is it a great idea? Do you make a lot of money? It's not a huge commissionable item, but you know what? So you're getting 40% or 30% of $3,600 plus 3% on a $29,000 dumping. It's not too bad.
And they become a client, and then they start, oh, what about me?
Right. So
David, if you don't mind me asking, who do you usually use for that? Is it like Foresters or?
no, I use Security Mutual.
Okay, never heard of them.
Mass Mutual has one. Foresters
Mass Mutual.
has one.
Okay,
Cincinnati Life. Anybody that has a whole life contract, they have premiums paid in advance.
got
Yeah,
it.
I don't think
Okay.
Mass Mutual has a single pay like that though,
I
unless
know
it's put
Foresters
in.
has like the 20-year pay, but
Well, yeah, it's a prepay. You could prepay a 10-year contract,
Mm-hmm.
a 20-year contract. You could prepay part of your life insurance on a whole life 100, but I don't recommend doing that because then the premium comes back in the 11th year and the client thinks they paid all their years and then you're gonna have they don't not gonna remember what you said 10 years ago. You know what I mean? So that's why it's important to meet with them. But 10 pay, prepay it for 10 years, it's not a big deal. And I've used that contract. I just did one for a friend of mine who sold his business. And part of his business buyout was a $20,000 a year whole life policy. In the unlikely event he dies because his kids still want to get the payout, the business partners, et cetera. But the reason why is irrelevant. But it was $180,000 prepay 10 pay contract. He's a young guy selling his business, and that was part that 200,000, 185, call it 200,000 of income or benefit to him was part of his payout package. He said that's a great idea. So, you know what I mean? You could use it for to have bigger premiums too. So, yeah, I wouldn't be too scared of it. And like I said, have the confidence. Don't be scared of the whole life policy. Don't be scared of the universal life policy. It is a bigger premium, but we can find it if we want to. So,
Great. Anyone have any last questions for Dave? It sounds good.
Wes,
Good.
you okay down
Good,
there,
thank you.
Wes?
Hey, sorry, I got kicked out last week. I was traveling.
Okay. All
I
right.
didn't get my internet, but
I like your background, Eddie.
oh my yeah,
Yeah.
Zorro, my Zorro background, the US.
Yeah.
Yeah, Wes, Christina, make sure you guys have Dave's number. He's more than happy to help you guys with any case designs or just help you out with anything. He's always there for me whenever I need him. I'll call.
Anytime. I answer all phone calls.
Like I'll have someone on the phone. I'm like, shit, I don't know about this. I gotta call Dave, and I call Dave. Like, Dave, I got someone on the other line. I need you to talk to him real quick because I don't know what I'm doing here. And that's how I learn, right? By having somebody like Dave that can be there for you to help you and learn from him doing it, right? That's how I've learned a lot.
Okay.
So make sure
I'll
you
wait for you.
utilize
What's
Dave.
Dave's phone number?
Yeah, Dave, what's your number?
551 427 1515.
Perfect. Thank you so much, Dave. I really appreciate your time. Everything
Thank you
was super
guys.
informative.
And I learned from you guys too, I mean that's key, you know.
Yeah. Last thing, Dave, if you can send us that one questionnaire paper or send it to me and I'll give it to everyone, like those questions you
Oh
ask
yeah,
every
sure.
client. And
Yep.
then if you
And
have that sequence of return thing, I think that's very powerful to be like, hey, in 10 years, 20
right.
years, there's a 15% drop. Here's this whole life compared to that.
Okay.
I think that's also something that would be good for us to have as well.
I will do that for you.
All right, great.
And your
Well,
whole life illustration or cash value policy is going to be probably a little bit different. I'm just using the one I have, so
yeah.
that's irrelevant. It's just the concept of the return. So yours may even have more cash value in it. You know what I mean?
Hmm.
It's just once again, it's conceptual. I sell a concept, and that's what I like saying to the client. I got a concept I'd like to get your opinion on.
Yeah.
Usually everybody wants to give you their opinion. So
Yeah, I say that all the time. And I'll get your opinion on this.
yeah, exactly. So
Okay, awesome. Yeah, probably I'll have to come up with another idea for you to do next week. I liked one that what the hell is his name from Mass Mutual? The Tony Mazza. It's
right.
like my bond versus your bond. It's like why invest in bonds when you could be putting into like a life insurance instead that's going to outperform. I think that's a good one.
Yeah.
But yeah, if you have any ideas, let me know. If you guys want to hear any other concepts or ideas or trainings, just let me know and I will find somebody that can come and talk about it. But tomorrow, make sure you're here for Nikki, which is again at 4 Eastern, I believe.
All
I'll
right.
send it to you guys as well, but make sure you mark that off. She'll be going over IUL specifically and basically be doing what Dave does, but for IUL
Okay.
products.
I'll be there.
Awesome.
Thank you, Nick. Thank you, guys.
Thank
Wes,
you. Thank
Eddie.
you, David.
Thank
Thank you,
you.
Good seeing your
I
face.
appreciate
everyone.
it.
Good seeing your face finally, Christina. After
Oh.
oh,
Okay. Thank
All
you.
right, guys.
bye.
Bye.